Welcome to Paradigm Playbook, the podcast on the business of sports. With 50 plus years of experience, Steve Cook shares insights weekly, featuring top playmakers shaping the industry. Get ready to script your next play. Now, here's your host.
Hello and welcome to Paradigm Playbook. Today with me on the podcast is Jason Bush. Jason was on with us a couple months ago. I think it's been a while, Jason. Jason has many facets to his life, his career, and his business. One of them is real estate, another is consulting, the overlap of consulting on real estate. Do you want to fill in your introduction of anything that I didn't say about you?
Sure. Yeah, no problem at all. So, Steve, thanks for inviting me back. I always enjoy our conversations, whether or not they're being recorded or not. So I always look forward to the opportunity to talk with you. We always uncover some nugget that improves what either one of us is doing. So I love that. I'm one of 6 partners in a commercial real estate strategic advisory firm. We're based in the Carolinas, but we do work nationally. And we love working with business owners and supporting their efforts to grow their enterprise value, as well as help them seek success within their real estate strategy, as well as their business strategy. So we help them grow via acquisitions of businesses and real estate. That might be the most unique thing about what we do, and the connection, Steve, to your world is that we focus on commercial real estate, but we're really a business advisor that happens to have a subject matter expertise associated with the real estate asset that these businesses operate within, either if they lease it or if they own it. So maybe that's the segue into the broader conversation, but we feel like we've really differentiated ourselves away from what is viewed as being a traditional commercial real estate brokerage.
Okay.
That is a function of what we do, but really it all stems from our strategic advisory, which may or may not lead into a brokerage opportunity.
So one of the things that I'm hearing, and I listen to all kinds of podcasts and conversations, and there are financial advisors out there doing podcasts, and you hear in giving advice just to individuals in the real estate, now's not the time to buy a house. Now's not the time to do this. It's better to rent than buy. By the end, when they're doing all these calculations, I have my own view on it. So I'll tell you where I stand. I've always felt that owning the real estate, and one of the current businesses I'm in owns the building that we operate in. And I've always felt that if nothing else, for me, it was a forced savings plan in that somewhere where I'm building equity, whereas if I'm just taking my cash flow, I'm not necessarily always taking a percentage out and putting it aside to put it into retained earnings or anything like that. It's kind of how I felt about my home too. It's like I overbought the home I live in, not because I needed it or wanted it or cared about any status, just because it would grow faster. 100,000 at 5% grows faster than 50,000 at 5%, just dollar for dollar. Anyway, we have a lot of entrepreneurs in the audience that are renting now, and they've probably thought about buying that building or buying a building. What's your advice on timing?
I love the way you frame that question. I'm going to answer it in a slightly different way than maybe what you were hoping I might.
Okay.
So for me, buying versus leasing really comes down to 2 factors. It's like the strategic direction in which you're taking your business and your view on building total enterprise value, as well as what capital do you have access to at the time and how do you choose to allocate it. So capital is a resource that you can choose to spend on various types of assets, right? So if you're an existing business owner and you've got X amount of capital, you can use that capital to be the down payment on a property purchase, and you've got to take on some debt in order to do that, right? So you're making a commitment of that capital towards a real estate asset. But you can deploy that capital in other ways too. You could acquire a competitor and roll that into your operations that way. You could make an investment in your people. So there's a strategic element to what generally is a limitation on the amount of capital that anyone has access to at a given time. So maybe to help explain that a little bit more deeply, I'm going to use an example of 2 companies that have unlimited access to capital, but yet one owns almost all of their real estate, one almost owns none of it. It'll help highlight this connection between capital allocation choices and strategic intent. What I like to explain is the example of McDonald's versus Chick-fil-A. Both gigantic corporations. They can have unlimited access to capital, right? If either one of them needs something, they can get it. right? In the McDonald's example, regardless if it's a corporate operated store or a franchisee operated store, McDonald's corporate will own 99% of the real estate under all of those stores nationwide. And the reason that they've done that, they've elected to allocate capital towards the purchase of real estate. And they use that income that real estate generates because the business, the McDonald's franchisee or the operation leases that real estate from McDonald's corporate. So really what they're doing is they've created an operational hedge for themselves where part of their business is receiving rental income off a real estate investment, as well as they're selling Big Macs. The real estate income is kind of a hedge against an operational downturn, customer preferences changing, that kind of thing. So they've made a commitment to put capital into the real estate entity. Now, comparison is Chick-fil-A. Again, they're basically in the exact same business, right? We're going to define that as just fast food, single tenant retail fast food. Chick-fil-A, regardless of who the operator is, be it corporate or a licensee or a franchisee, they rarely own the real estate underneath their buildings. They almost always lease that building from a third party owner, just an investor owner who's happy to have Chick-fil-A as a tenant because it makes the real estate incredibly valuable when you have Chick-fil-A as a tenant. But Chick-fil-A could buy all of the real estate under which their stores operate, but they elect not to because they have chosen to reinvest their capital into supporting their operations. And I would say that's probably a really good choice because an average Chick-fil-A across the country averages about 8.5, close to $9 million in annual sales. McDonald's is 3.5 million. So I use that as the example to explain that there's not necessarily a correct answer to your original question. It really depends upon strategic intent and how you want to choose to allocate your capital.
So very often my conversations start with my clients. Are you creating a lifestyle business or a growth business? So is this something you want to scale and grow, or is it something that you want to be comfortable? You want to take 2 months off in the summer? I'm in favor of either one of them. I only live in one world, but I understand the people that live in another. And I try to get everyone, and maybe you disagree with this, but I feel like whichever way you choose to go, it's possible. So
yeah, 100%. Yes, that I agree.
If you're saying it's based on capital on hand, then if we want to buy it, we want to go into that business, which will create more equity down the road. Maybe we have to take on a partner that allows us to make that step in, but then the equity in the business will grow faster. Again, I'm going to turn it into a question rather than a statement.
Okay.
Is it a matter of risk versus bravery? You said it's not smart versus not smart.
Absolutely, right? There's a spectrum of people as they're from conservative to Katie bar the doors, I'm willing to try it, right? There's a spectrum between those two. And if you're on the conservative end of the spectrum, taking on debt to fund a real estate acquisition, especially if it's a recourse loan or you've got to put a personal guarantee on it, that makes some people feel itchy. That might be somebody who's way more comfortable just operating with cash and capital on hand. Like we see that all the time. Doesn't mean it's right or wrong. That's just how their world operates. And then you've got the other end of the spectrum. You think about private equity and roll-ups, and those are leveraged strategies, right? That's the other end of the spectrum where they're willing to take on leverage, AKA risk, in order to receive outsized returns. Right. So that's really the concept, right? Your conservative nature is going to, because it's less risky, you're not going to have the ability to create above average returns. Whereas if you were in the risk threshold and you're willing to take on leverage, that's how you obtain above average results. It's because of that leverage factor. So your original question is dead on, right? There's a spectrum of risk and risk tolerance that allows somebody to execute a specific tactic.
I'm always willing to accept when I have an idiotic point of view, but in this case I do. So when
I doubt it.
maybe just an alternative point of view, that when I was buying one of the businesses that I own today, I've owned for 22 years, my objective was that if I couldn't buy the building with the business at the time, I wasn't interested because it was too risky. And I considered that risky. Two things. If I buy the building, I understand what my monthly payment is from day one, and I can control that. That's what I thought at the time and has proven out. If I rent, I don't know what the rent could be next year.
Sure.
And I don't know what I'm going to do at the end of a term. Or I was on an SBA. We had to get a 10-year lease if we were going to do it. Basically, we had to get a lease that matched the term of the loan.
So as an acquirer, I would agree with that approach. because anytime that you have the opportunity to acquire business and the associated real estate at the same time, that creates advantages for you as the acquirer because the lending or the financing sources that you're planning to utilize, they love it when there's real estate attached, right? Because there is collateral that benefits them as the lender, right? Because if you're acquiring something, the business entity is valueless at that moment, right? You've created Steve's new LLC. It has no assets on the balance sheet. Like that, lenders don't like that, right? So given the alternative of acquiring the business or the business plus a real estate, I think you're definitely in an advantage position by attempting to purchase both. Also creates optionality for you because everyone's going to eventually exit that business. When you hold both the business asset and the real estate asset, and you've got them structured properly and you manage them as two separate things, they're separate legal entities, leasing one to the other at an at market rate. Now, when you exit the business, you've got transactional flexibility for the next buyer that comes in to buy the real estate. Like private equity would come in, they'd only buy the business. If it's a local strategic buyer, they might buy both, and they might love the fact that you're willing to sell both. Or you may only elect to sell the business. You may end up for your lifestyle and future rental income, you may decide to hold the real estate.
Hold that thought for a minute. I'm going to come back to that because I have a specific on that. But I have clients that tell me, yeah, I don't want to buy because I don't know how long I want to be in this location. I'm going to outgrow this location. So what's your thinking about that train of thought?
Yeah, so then it's a function under that strawman example, right? They buy the business, they buy the real estate, their business is incredibly successful, they grow, right? To a point where their original facility doesn't suit their needs. Is that kind of the example that
yeah.
When you're assessing the real estate that you're acquiring, essentially what's happening is the tenant is leaving, right? The tenant being the business that you bought. You can release that space to someone else,
right,
depending upon its suitability for someone else, right? So like a lot of the businesses that we work with in the CAC space, it's warehouse space, it's converted. There's been some improvements to fit the specific need, but generally those are pretty in-demand spaces. If I was giving that particular client advice, I would help them see it as two separate things and not see it as a joined entity. The real estate will suit the business owner's needs, but if the business owner leaves, they still own that real estate. They just need to release it to somebody else. They might lease it at a higher market rate than they were paying as a tenant. And that's how you really start to create wealth.
So that brings me back to the idea that you brought up a minute ago. So you buy a package deal, but in two companies. And then the real estate grows very rapidly. You're in a high population increase area, something goes, there's an in demand for what you have, and the business does fine. It pays what you're charging it, you're paying the mortgage. So when you have that internal two companies that are sister corporations and you're paying yourself, it's okay. But if you're going to sell the business, then you want to turn the rent up to market value. And now all of a sudden that business can't afford your own building.
But another business might, a warehouse type of facility. Like there's a reason the value of those buildings went up, right? Because that type of asset class is in demand, and it's in demand by demand is outstripping supply of that type of asset. Even though the exiting business might not be able to pay the rent, that's fine. Because if the market has reached the value of that real estate asset, it's largely driven by the demand for that type of asset. So there should be another tenant that's willing and able to come into that and pay a market-based rent.
And I don't think that's the issue. It's that, do you lose the value in the business if you're trying to sell a business with no location?
If you're attempting to sell a business with no location, you have an unsellable business, right? It doesn't matter what the financials say.
Yeah. Let's look at it a different way. By investing in the real estate, I looked at it as a growth opportunity. And you mentioned this earlier. If you're building equity, you have something to borrow against. So that's where I got the investment capital for my next business, was leveraging the real estate. When I couldn't do it with the business, I leveraged the real estate, put it into a third business. Do many of your clients look at that as a opportunity, a growth opportunity?
Yeah, there's different ways you can use the real estate asset in order to fund growth, to create a capital source for additional growth. And so your example is you were using your real estate asset who, over the period of ownership, you'd acquired significant equity in that real estate. So you could borrow against that equity to fund whatever the heck the next thing was. That's somewhat a function of the duration of which you owned it too. You bought it at a time when it was way less expensive than
Yeah.
what it currently is worth, right? You benefited from the duration of your ownership, right? Not only in just valuation, but also you created your own equity in that thing, right? Which became a nice collateralized asset to create an additional debt stream to fund something else. Not everybody has the ability to benefit from duration, or they've already leveraged the hell out of that asset, right? So there's limitations to the strategy. The way you played it is perfect. Another thing that we see is that somebody who owns the business and the real estate, they want to acquire a 3-unit competitor somewhere else. Just this amazing once in a lifetime opportunity came by, and they need to raise capital to do that. One of the things that they can do is execute what's called a sale-leaseback strategy, where they, as the tenant, will execute a new at-market lease with the real estate entity, and that will create a new income-based valuation of the real estate. And then they will have secured their tenancy with a 10 or a 15-year lease. But now the real estate has a new valuation attached to it. And then they sell that asset to an investor that's just willing to be a check collecting landlord. And then they use the proceeds from the sale of that real estate asset to fund the acquisition of something else. So that's called a sale leaseback. And it's really, really common.
Interesting. Do you see that in the CAC marketplace? Is that happening?
Yeah, it should be happening. Like it's a strategy that really applies to almost any sort of business. Like as long as there's the ability to, when they own the business and they own the real estate, they can create their own capital channel via the sale of the real estate asset.
So what happens to the capital gains? We still have to pay the capital gains at the point of sale?
Again, there's no stock answer for this question either, right? If they're purchasing real estate as part of the next acquisition, then you can fund that as a result of doing a 1031 exchange where you can defer the capital gains tax associated with the real estate sale. And so that's a strategy. It depends on their larger view too, right? They've been harvesting losses in some other thing in their world. That might be enough to offset the capital gains from the real estate sale. Tax avoidance is a tactical thing, in my opinion, that is, you try to minimize it as best you can, but I always try to make sure that the people that are using the right tax avoidance strategy, that it fits in like their strategic view. There should be a capital gain tax that's associated with that sale, but there's multiple ways to offset that. I guess is probably the simpler way to answer that question.
And then there's also a philosophy that, the amount of tax you pay is a barometer of your success. You can't offset it all. So take pride in being a profitable company. Suck it up, pay what you need. Now, as long as they're not jacking taxes up to where they're
right.
Selling property that falls under the capital gains as a timing issue as much as anything else in the political atmosphere, because that capital gains rate has been all over the place, and
yes, it has.
It's threatening a move again. So it's something that we have to pay attention to.
Yes.
Give me 3 reasons that I'm going to really put you on the spot. 3 reasons that I don't want to buy the building that my business is in. What 3 things would be red flags to you that say, you know what? No, that's.
Yeah. Environmental concerns are always going to be a challenge. Right. I would never take on unknown environmental risk. That's a bit of a bailout answer, right? You were thinking strategically.
That's a good answer because you're made aware of that when you're buying. And normally you do have to do environmental studies to transfer commercial properties. That's obviously good, but that would be controlled by the market and the transaction. So that's going to be controlled legally, I think.
Yeah, generally, so that environmental study that's done, it's called a lender will require you to do it regardless of where the property is. And they'll do what's called a phase 1 environmental study,
right,
which is a historical evaluation of prior use of that property as well as neighboring properties. And from time to time, you'll uncover either an odd use of the property prior to your interest in it, or a neighboring property will have been a dry cleaner or something that was just environmentally challenged. And the risk of that leaching into the dirt underneath your building is real. And so that's what will trigger often a further environmental study that's called a phase 2. Really, it's a lender requirement. Generally, my recommendation is just to avoid all of that if you possibly can. So that would be one reason. Your question was what reasons to not buy the real estate?
Yeah.
Sometimes it's just not an option. for you. So it's not that it's a yes or no decision. It might be just purely it's not something that's acquirable at this stage, right? So you've got a business owner that wants to exit, but they own the real estate and the business, but they realize that they want to hold the real estate, but yet you see strategic opportunity within the business that they're selling, right? It might be in a period of decline. It might be operationally inefficient. Like you might be able to just make a killing by acquiring the business that they have mismanaged, and you can apply your talents and techniques and processes to make it thrive again. That would be a reason to focus just on the business asset. And again, it's a bit of a cop-out answer, but you wouldn't buy it because it's just not available. But that doesn't mean you shouldn't proceed because of the opportunity that exists within the business acquisition.
And I guess I could double back and say it all is possible depending on what kind of partnership or partners you're willing to take on in the business. So
correct.
Person with great expertise and a great person with great money get along really well if they can figure out how to balance the partnership. So one more. So if you can't afford it, environmental.
Yeah. And then the third reason might get right back to the start of our conversation, which is your risk profile, strategic intent, allocation of capital that you have on hand. Given those three factors, at the time that the purchase opportunity presents itself, you just may not be in a position to acquire it, right? Because you've got another acquisition in the channel. You had a period of time where it hurt a little bit, the business, and your cash lean. Like you just might be in a conservative period of your growth. And so it would be that mixture of capital strategy and risk profile that might make you consider not buying the real estate, making that capital outlay at the time.
And I guess I always think that if the business is currently paying for the real estate, then in a transfer, if purchased at a fair price, it should continue to cover the real estate.
That's the other equation, right? Sellers are often very ill-informed regarding the value of their real estate, and it may be available, but it's not at a price that makes sense. You got to buy smart.
Okay. Yeah, that makes sense. If we're just saying owning versus renting effect on the year-to-year P&L, aside from taxation, how are you recording your business differently with an owner property or a rental property?
I'm of the opinion that you shouldn't record that any differently, regardless of your ownership status.
Oh, so you're separating the businesses and then paying. So either way, you're paying rent. It's just that you're paying it to yourself.
Correct. And let me, if you allow me, I can dig into that a little deeper to help explain why I believe that it should be the case. So what we commonly see, and it's a function of the timeline in your evolution as a business owner too. So here is our prescribed advice when you own both the business and the real estate. First of all, you've got to have them as separate legal entities. You've got an operating business. Think of your ownership of real estate as the real estate business, right? True separation of church and state. You've got a separate P&L for your business. You've got a separate P&L for the real estate. The last thing I want to see is somebody that acquired both at the same time under one LLC just to continue to operate it that way. You got to have a separation of entities. A common mistake that we see is that a business owner will own them both and they'll lease the location from the real estate entity at financially flexible terms, right? So they'll lease it basically enough to facilitate the debt, the insurance, and the taxes on the real estate, right? And so what that equates to is you have an under market rent that you're paying to the real estate entity, which is fine if you're 15 years away from exiting that business. It really doesn't matter, right? The accounting it's your own personal accounting. It doesn't really matter. But as you get closer to exit, say you're 3 to 5 years out and you're contemplating potentially selling the business, this is when you really have to have this stuff executed at market-based lease rental rates. Because if you rent it at under market to yourself, right, what you're essentially doing is you're propping up your business P&L by not charging yourself enough rent. A savvy buyer, as they are doing their due diligence on your P&L and you're going through your earnings, they should recognize the fact that, oh, Steve's occupancy cost is way, way lower than it should be. I should expect to pay a market-based rent. And so what's going to happen is that buyer is going to create a take back onto that business seller's P&L. They're going to reduce their EBITDA. Therefore, the business is going to be worth less than as initially presented. You follow?
Yeah, I'm with you. Yeah, this is
Okay.
fascinating.
Okay, that's going to happen. You're going to suffer the valuation impact regardless if you're paying yourself the proper rent number or not. So pay the right rent number. And here's why. So now you've got rent flowing from the business into the real estate entity. And that allows that real estate entity to be valued on an income-based valuation. So that is essentially take the base rent and divide it by a cap rate, right? Which is essentially a proxy for an acceptable investor rate of return. And so CAC space, what's the exit multiple generally that's applied to the business? Like a 4, a 5?
Yeah, 4.
Yeah, so let's call it a 4 for whatever type of business it is, right? Your EBITDA stream, a great buyer is going to pay you a 4x multiple for the operating business. Let's look at the valuation of the real estate entity. So that real estate entity is going to be valued at the income stream that's associated with, which is AKA rent. You're going to divide it by a cap rate, essentially an 8% cap rate, which is equivalent to a 12x exit multiple. So what you're doing is when you pay yourself a market-based rent, you're taking $1 of NOI, $1 of EBITDA from the operating business, you're transferring that $1 of EBITDA into the real estate business. But that $1 of EBITDA in the real estate business is probably worth 3 times what it was if it was left in the operating company. That's how you build real wealth, is by paying yourself a market-based rent, because that dollar is way more valuable in the real estate entity than it is in the operating business. And so that's the real value add play that my team can provide to a business owner that has the real estate and the operating business when they own them both, is to educate them on proper leasing concepts, proper ownership concepts, valuation concepts, as well as helping them get all that blocking and tackling in place so that when they're considering exiting the business, now they've got transactional flexibility because they own 2 things. The books on those 2 things are managed properly. And now you've got transactional options. You have 2 things to sell. You can sell them to multiple buyers. You can sell them at different times. You can only execute all of that stuff, that transactional flexibility and optionality, if you have all the blocking and tackling in place in a proper way.
Fascinating. Yeah, we're out of time here, and this always happens to me. I get into these conversations.
We really get into the meat of it right at the end.
Yeah, that was really good. In closing, I want to remind everybody that we've got our signature business workshop coming in December, the beginning of December. There's information about it on the Third Level website, or contact me. But Jason is one of our speakers at this event. The beauty of this event, it's a workshop based. So Jason will be able to sit down and work the group through where you're putting numbers on paper, your numbers, and calculating these things and try to figure these things out and say, is your current operating process making you money or costing you money? Fascinating information. So I'm really excited about what you're going to be doing at the workshop. Any last comments to intrigue people?
I'm really looking forward to the workshop, and I'm excited to meet as many business owners in this space as I possibly can, because the concepts that my team apply to business owners it's perfect for the CAC space, because every one of those locations has to have real estate, right? You either lease it or you own it. And so the tools and techniques and the strategies that my team has developed apply to every single CAC business owner, regardless if you own the real estate, right? Even if you just lease it, we can still focus on the benefits that you receive in exchange for your lease payment and making sure that you're maximizing those as well. So
the businesses that are in this space, the business owners that'll be there, are in a business that is very sustainable. We're not the businesses that are pushing the closure rate up.
correct.
Children's activity centers stay in business. And if there's any downside to it, it's they get a little bit too dependent on the owners, which we could get into that as another conversation. And
Sure.
I'm sure
Yep.
we will there. But once again, if somebody wants to reach out to Jason.
So our company is Linville Team Partners. You can find us online. I'm on LinkedIn. I'm available almost 24 hours a day. It's really embarrassing how much I'm available at this stage. And then Steve, I think we'll have a link to either our website, or I've got QR codes that I can share with you all too that have direct access to my calendar if a business owner wants to have a conversation.
And if you want to set up a pre-conference meeting with Jason, we're going to be in Orlando, and anybody that's going can we're using the Hoova app, and you can get on Hoova, follow the Third Level event, and you can connect directly with Jason on there and set up a meeting. So it's a fascinating thing. So we're all very excited about it. Jason, thank you so much for this. I'm sorry we went a little bit long, but I do appreciate your time.
Steve, as always, I love talking to you. Let's do it again soon.
Okay, thanks.
Thanks for tuning in to Paradigm Playbook. Explore more at paradigmplaybook.com. Want to be a playmaker? Contact stephenjcook.com. Share this episode to spread the word about sports industry opportunities. See you next week.